Hello, folks. Welcome to this session. I'm going to talk about Chapter 10 Bonds. First, what are bonds? Bonds are written or printed acknowledgement that a company has borrowed money. These bonds, earlier in British system, were called debentures. Each bond will have three things printed on them: face value of the bond, usually $1,000 or higher; rate of interest, which the borrowing company would be paying to the lending public; and life of the bond, usually 10 years, 15 years, longer period. Therefore, we say bonds are non-current liability or long-term liability. Now, we need to see just point here and there that when you borrow money, the idea behind that is that you would be earning more than what you are paying to the public. If you borrow money at 10%, the common sense idea is that you must be earning more than 10%, otherwise, what is the use of borrowing the money from the public? And because of this particular peculiarity, the feature of bond, the overall earning of the company for the shareholders or the investor gets better. Also, whatever interest you pay to the public, that bond interest is allowed as an expense. And because it is allowed as an expense, it will affect your profit and you will save tax on the expense which you have paid. So bonds have some own positive things. So now let me tell you three type of entries which are unavoidable in case of bonds transaction. First is issue of bonds. Number two, payment of interest. Number three, repayment of bonds. Repayment is also called redemption of bond, which is at the end of the life of the bond. Let us say that for the sake of convenience, let us say you are issuing one bond of $1,000, rate of interest is 10%, and the life of the bond is 10 years. Now, this 10% interest, which we pay to the bondholders, our undertaking is that when you bring back the bond to us, we will give you $1,000. Bond for our level in 201 would be bought back to us after 10 years. And we will be paying 10% interest every year on the face value of the bond. What is the face value? 1,000. How much is the interest every year? $100. $100 for 1 year would be paid 2 times in 2 bits, like $500 by $50 and $50. So bond interest are stated annually, but we pay it 2 times every 6 months. So let me give you the simple entries. When you issue the bonds, the company will receive cash. So cash account debit, $1,000. Name of the liability which we have created, 10%, 10-year bonds payable. Payable means liability, $1,000. So company gets $1,000, created a liability $1,000. The paper, which we call bond, is in the hand of the public or the person who has loaned the money. Now, the interest, second type of entry. What will be the entry for interest? bond interest expense debit for 6 months. 6 months on $1,000 would be $50, and cash credit $50 because the cash is going out. This, in our particular case, because the life of the bond is 10 years, how many times you will make the payment of the interest? 20 times, because 6 monthly period come up during 10 years, 20 times. After 10 years, bonds will get mature. Their life is over. So you will buy back your bonds from the public. You will get back 10%, 10-year bond payable debit, right? And you will pay cash, $1,000, all done. Now, when you issue bonds, where do you show them? In the accounts. The cash you receive from the bonds will be shown on the asset side under cash, $1,000. Where will you show bonds payable? Because it is payable, so it should be on the liability side. So you will show on the liability side before capital, 10%, 10-year bond payable, $1,000. And you will see, because of this transaction, both the sides of the balance sheet are equal, $1,000, $1,000. Now, let us elaborate the example. So let me repeat again. The face value of the bond, $1,000. We also call it printed value of the bond, $1,000. We also call it par value of the bond, $1,000. The rate of interest, 10%, which is given, is called coupon rate, is called printed rate, is called committed rate, is also called contract rate. All these four terms you can use for it. And 10 years is the duration of bond, is the life of bond. After 10 years, the bonds will lose their relevance. You have to buy them back. Now, let us say the simple thing. You issue bonds of $1,000 carrying 10% interest for a period of 10 years. Okay. How many bonds did you issue? To keep the example simple, let us say 100. So 100 bonds were issued of 1,000 each at 10% for 10 years. So when you issue the bonds, the entry would be cash account debit, $100,000, 10%, 10-year bond payable, $100,000. Okay? How did we get $100,000? Because we issued 100 bonds of $1,000 each. Now you will make the payment for the interest. Interest payment is for 6 months. So on 100,000, 10% would be $10,000. But you are paying 6 months, so you're paying every 6 months 5,000, 5,000, 5,000. So what is the entry? Bond interest expense debit, 5,000. Cash credit, $5,000 because cash is going out. This entry, in our case, we will make 20 times because 6-yearly period, numbering 20 will happen during this 10-year period. After 10 years, when you have paid all the 20 installments of interest, you will be redeeming the bonds, repaying the bond. And what entry you will make? 10%, 10-year bonds payable debit, cash credit, $100,000. Once you make the payment, you don't have to do anything. I hope you have understood this without problem. But as always, I request you to read the chapter, the example which is given in the chapter, try to look at it, and the sample test I have given you earlier, you try to look at the similar question, see whether you can do them or not. Now, let us make a talk about something else. Again, relating to the bonds. At times in the market, when you promise that you will give 10%, but other companies, the other corporations of the market are paying 12% or 14% interest. Now, when others are paying 10% or 14%, no person is going to come and buy your bonds because they are going to get higher rate elsewhere, but you need the money. So what will you do for the public? You will tell the public that we have committed that we will pay 10%, we can't change it. But we can do one thing for you. At this time, you give us a little less money, like $950 for each bond, $950. But as per the law, we will promise to pay you back $1,000 at the end of the life of the bond. Our interest rate will not change, it will stay 10%. So in this type of situation, when the market rate is higher than our printed rate, our coupon rate, our committed rate, our contract rate, whenever market rate is higher than that, we will have to issue bonds if we need money at discount. Now, when we issue the bonds numbering 100, face value $1,000, at discount of, let us say, 5%, 5%, what entry will we make? Our entry would be cash account debit, $95,000. Bond discount debit, $5,000. So there are two entries in the debit, 95,000 and 5,000. And what liability we have created? 10%, 10-year bond payable, 100,000. Clear? First entry at the time of issue. Now, where do we show these things? Cash account, 95,000 we will show on the asset side. Where will we show the discount? Discount is actually a loss, but we don't show in the income statement. We show it is on a liability. So let it continue on the liability side along with the liability, indicating or disclosing that we did issue the bond, but at a discount of 5,000. So you will be writing on the liability side 10%, 10-year bond payable 100,000, less bond discount 5,000, net value at this time of the bond 95,000. So asset side 95,000 in cash, liability side $95,000 equal. Now we say because this $5,000 is to be written off, okay? Over what period it should be written off? Over its life. What is the life of the bond? 10 years. And the question is, when should we write it off? Accounting rule says whenever you are making the payment for the interest, that very time you also try to write up the bonds. The write off the bonds, you may recall, is called amortization. Amortization we have done in chapter 8 when we talk about the depreciation or depletion. In case of intangible, we use the word amortization. So we will be amortizing the bond discount. What entry do we make? We will make the entry bond interest expense debit. Now, because we are writing off the bond discount, because it was earlier debited in the first entry, so when you are amortizing it, writing it off, you should credit it. Whenever you have to eliminate debit, you credit it. So the entry would be bond discount credited. How much? 1/20th of $5,000, that is $250. How much interest you will be paying? Typically, you will be paying, as we have paid first year interest, 6 monthly, $5,000, right? So $250 for the bond discount in the credit, 5,000 cash credit because the cash is going out. So bond interest expense would be 5,250. Every year, you will, every 6 months, you will be making this entry. Because you are writing off the bonds every 6 months, your value of the bond discount in the balance sheet would be getting reduced by 250, by 250, by 250. So over 20 installment of 6 months each, your entire 5,000 will disappear and you will be having only 10% 10-year bond payable $1,000. When bonds are matured, time has come to redeem them or repay them. So the last entry you will make 10% 10-year bond payable debit 100,000, cash credit 100,000. So everything done. I hope you remember, otherwise you watch it again. Now, the other part of the example. We assumed in the earlier case that the bond prevailing market rate of the other company was 12%. But suppose another time the prevailing market rate is 6% or 8%. Now, in that case, that means if you are paying 10%, you are paying better than others, the rate of interest. So at that time, you can issue bonds at premium. Premium means that if the bonds are worth $1,000, you can issue for $1,100. Right? Now, how do we then handle the situation? So let us keep the example simple. $1,000 bond, 100 number at a premium of $100. $100 each. So what entry will we make? We will say cash account debit, $110,000. Bond premium account, $10,000 premium, and 10% 10-year bond payable, 100,000. Bond premium, because it is a gain to us, so we put on the credit. How do we show in the balance sheet? 110,000 on the asset side under cash, and on the liability side, 10% 10-year bond payable, 100,000, and add premium, $10,000. Outer column, 110,000. You can see the balance sheet is equal on both the sides. Now, as we did for discount, we should also follow the same logic. We should try to write off premium account. Write off means we should amortize over the life of the bond. When should we write it off? Whenever we are paying interest, at that time we should do it. So let us see what entry we will make for the interest. We'll make the entry bond interest expense debit. Okay. Initially, we credited bond premium. Now, because we have to amortize it, we should debit it to write it off. So we will debit bond premium. Okay. How much? Our premium was $10,000. It will be written off over 20 periods of 6 months each, so $500. So bond premium, you will debit $500. How much cash you are going to pay to the public for 6 monthly interest? Cash, $5,000. Okay. How did we get 5,000? On 100,000, 10% interest, 10,000. Half of it for 6 months, 5,000. And what amount you will write in the debit bond interest expense? $4,500. So the entry is bond interest expense $4,500, bond premium $500, and cash account $5,000. This entry will make 20 times because there are 26 monthly period over the life of the bond. After we have written off the 6 monthly premium, in the balance sheet, we will reduce the amount of bond premium by 500. Every 6 months, we are reducing 500, 500, 500. So after 20 years, the entire $10,000 would be written off. And now bonds are maturing and you will be repaying the bond, making the simple entry the same as we have done in the other two cases. But 10%, 10 years, bond payable, 100,000, cash, credit, 100,000 because we are paying this thing. Now, think about this thing I've told you. It should be all right. And if there is a problem uh, when emails start working for me, you can write to me and check with me again. Again, let me repeat, do read the chapter, but don't read the entire chapter because the later on part we have not done, not relevant for you. We have done the amortization simple method, straight line method. Don't bother about the other thing. So only first 8 or 9 pages you should read of the chapter. Practice them, should be all right. Now, another thing I would like to share with you. Sometimes question may read that bond was issued at 104 dollar each. Now, what does it mean? Because we say bonds are issued at, let's say, $1,000 bunch. But 104 simply indicate that the bonds are issued at premium. What is 4? 4 is 4% of 100. So we will say the bonds were issued at 4% premium. The same type of thing, if bonds are issued at, let us say, 98, that means bonds are issued at a discount of 2%. 100 minus 2 is 98%. Keep that type of thing in mind and read the chapter, and God willing, you will do better. General comment, general suggestion, general recommendation. Read the chapter. At the end of each chapter, there are 5 multiple choice. Try to see which you can do. Quick study, exercises, do 7, 8 of each. Should be all right. And I have given you the sample test. Try to go over that for each chapter. Like for the final, you should do chapter 10, chapter 11, chapter 12. For the third test, you should do for chapter um, 7, 8, and 9. With my best wishes, we will talk about this later. Okay, thank you very much.